If the economy is strong, then why does it feel like everyone around us is quietly struggling? Before we start, I want you to do something simple. Open your banking app, look at your grocery bill from 3 years ago, look at your rent, look at your savings, look at your credit card balance. Then ask yourself one question. Does this feel like a healthy economy to you? Because according to the headlines, everything is supposedly fine. Unemployment is low, the stock market keeps climbing, gross domestic product is still growing. The government keeps telling us the labor market is resilient, but regular people are exhausted, and that contradiction is exactly why this conversation matters. So if you have ever felt like the official numbers do not match reality, if you feel like you are working harder but somehow falling behind, if you feel like everybody around you is pretending things are normal while silently drowning financially, then hit like, save this video, and drop a comment telling me, does this economy actually feel healthy to you? Because I think millions of people are noticing the same thing at the exact same time. And honestly, the scariest part is not that a recession might be coming. It is that we may already be living inside one.
The data just has not admitted it yet. What most people do not realize is that recessions are almost never identified in real time. They are identified afterward, way afterward. That means by the time economists officially announce a recession, regular people have usually been suffering for months or even years already. Think about 2008. People remember the collapse of Lehman Brothers. They remember the stock market panic. They remember the financial crisis exploding across television screens. But the recession officially began in December of 2007. The announcement did not come until much later, after the damage was already everywhere. In other words, people were already losing jobs. Families were already falling behind on mortgages. Businesses were already collapsing. The economy had already broken underneath the surface. The official declaration simply arrived late. And the same thing happened during the dot-com crash and during previous downturns. Because the organizations responsible for declaring recessions move slowly, they wait for complete confirmation, they analyze huge amounts of data, they revise numbers repeatedly. That process can take months, which means something extremely important. A recession is not something you watch begin on television. It is something you realize you were already living through. And that brings us to today.
Because if you stop listening to headlines for a moment and actually look around, something feels deeply wrong. People are still employed, but somehow cannot afford life. People are technically working, but still drowning in debt. People are spending money, but only because they are borrowing it. And underneath all the polished economic reports, the cracks are becoming impossible to ignore. Take unemployment. The media constantly repeats that unemployment is low, somewhere around 4%. At first glance, that sounds strong. But the number itself hides a massive amount of reality. Because unemployment statistics only count people actively searching for work. If someone gives up looking entirely, they disappear from the unemployment calculation. Think about how insane that is for a second. Imagine a person spends 8 months applying for jobs. They get rejected over and over again. Eventually, they become discouraged and stop applying. According to the official system, that person is no longer unemployed. They simply vanish statistically. And since the pandemic, millions of Americans have quietly exited the labor force entirely. Not because they became wealthy, not because life improved, but because many simply stopped believing they could find stable work. That changes the entire picture. Suddenly, the unemployment number does not look nearly as comforting anymore.
Then there is another problem almost nobody talks about: job quality. Because the jobs replacing old jobs are often dramatically worse. This is one of the biggest hidden stories in the modern economy. Full-time careers with benefits are increasingly being replaced by fragmented part-time work, gig work, temporary contracts, and unstable side hustles. And statistically, this creates a dangerous illusion. If one worker loses a full-time salary job but takes 2 part-time jobs delivering food and driving rideshare just to survive, the system counts that as job growth. Think about that. One stable life disappears, 2 unstable jobs replace it, and somehow the data reports improvement. That is why so many people feel disconnected from economic headlines, because people are not experiencing prosperity. They are experiencing survival mode disguised as employment. Millions now work multiple jobs simply to maintain what one income used to provide. Health insurance disappears, retirement benefits disappear, job security disappears. But technically, they are still employed. This is why the economy increasingly feels like a movie set. From far away, everything looks normal, but when you walk closer, you realize many of the buildings are fake. And inflation made all of this dramatically worse. People talk about inflation like it is some abstract economic concept. It is not abstract.
It is your grocery bill doubling while your paycheck barely moves. It is rent increasing faster than your salary. It is insurance costs exploding, utilities exploding, healthcare exploding. It is the feeling of working an entire month and realizing less of your money actually belongs to you than it did a few years ago. Since 2020, cumulative inflation has crushed purchasing power across the economy. And once people can no longer keep up with rising costs through income alone, they turn to debt. That is exactly what happened. Credit card balances exploded to record highs. And this is where the illusion becomes dangerous, because consumer spending still looks strong on paper. Economists point to spending and say, "See, the consumer remains healthy." But they ignore one critical question. Where is the money actually coming from? Increasingly, it is borrowed money. People are not swiping credit cards because life is amazing. They are swiping credit cards because groceries still need to be purchased, even when wages stop keeping up. And at 20% interest rates, that debt becomes financial quicksand. At first, it feels manageable. Then suddenly, it is everywhere. A minimum payment here, another balance there. Buy now, pay later subscriptions, car loans, student loans, rent increases, until eventually an entire paycheck disappears before life even begins.
And this pattern is historically important because this is exactly how late-stage economic stress often appears before recessions officially emerge. Consumers stretch themselves thinner and thinner trying to preserve normal life, until eventually something breaks. And while households struggle, businesses are beginning to crack too. Corporate bankruptcies have quietly climbed. Commercial real estate faces enormous pressure. Small businesses face rising borrowing costs. Companies that survived the era of cheap money are suddenly trapped inside a much more expensive financial environment. For years, low interest rates kept everything artificially supported. Bad businesses survived. Debt expanded everywhere. Asset prices soared. But now the cost of borrowing has risen sharply, and highly leveraged companies are beginning to suffocate. This is one reason layoffs are quietly spreading across sectors, even while headlines continue celebrating strong employment. Then there is the psychological side of all this. People sense instability before the data confirms it. You can feel it in conversations. Friends delaying home purchases, families cutting subscriptions, young adults moving back with parents. People silently terrified to leave jobs they hate because they fear they will not find another one. The anxiety itself becomes economic data, but traditional metrics struggle to capture that.
And part of the problem is that many of the systems we use to measure economic health were designed decades ago for a completely different economy. An economy where stable careers were common, where single-income households could survive, where labor markets looked fundamentally different. Today, the economy is fragmented, digitized, financialized, and distorted by debt in ways previous generations never experienced. Yet we still use outdated measurements, pretending everything functions normally. And this creates massive blind spots. One of the most important concepts here is something called Goodhart's law. The idea is simple. Once a metric becomes a target, it stops being a good measurement. And modern economies are full of this problem. Governments target unemployment rates. Central banks target inflation metrics. Politicians target gross domestic product growth. But once institutions become obsessed with optimizing the number itself, they often stop improving the underlying reality. For example, if unemployment statistics reward any kind of employment equally, the system becomes incentivized to create low-quality jobs simply to improve the headline number. If gross domestic product rewards spending, regardless of whether it is debt-driven, then borrowing can artificially inflate economic growth temporarily. If inflation metrics exclude certain real-world costs people actually face, the reported number can look far healthier than lived reality.
This is why so many people increasingly feel gaslit by economic reporting. They are told the economy is strong while their own lives become financially weaker, and eventually the disconnect becomes too large to ignore, because reality always wins eventually. Always. The question is simply how long the illusion can continue before the numbers finally catch up. History shows that economic systems often appear stable right before major downturns. That is what makes recessions dangerous. They rarely announce themselves clearly in advance. Instead, they emerge slowly underneath the surface, while official narratives continue projecting confidence. Then, suddenly, everyone acts shocked when the collapse becomes obvious. But ordinary people usually sensed it long before economists confirmed it. And maybe that is where we are right now. Maybe the real warning signs are not hidden in advanced economic models. Maybe they are visible in ordinary life, in exhausted workers, in rising debt, in disappearing savings, in shrinking purchasing power, in young people delaying families because they cannot afford stability, in older workers postponing retirement because they cannot survive without another paycheck. Those are not isolated problems. Those are signals. And when enough signals begin flashing at the same time, it usually means something larger is happening underneath the surface. That does not guarantee catastrophe tomorrow.
But it does mean the official story may no longer match reality. And honestly, I think that is what millions of people are feeling right now. The economy being reported and the economy people are actually living inside feel like two completely different worlds. One exists in headlines, the other exists at grocery stores, gas stations, apartment leases, and monthly bank statements. And eventually, those two worlds collide. So maybe the most important question is not, will economists officially declare a recession? Maybe the real question is, how prepared are people before they do? Because by the time the announcement finally arrives, the people paying attention will probably already know. And if you made it this far, I genuinely want to hear your perspective. Does this economy actually feel healthy to you? Or does it feel like something underneath the surface is quietly breaking? Drop a comment below, because sometimes the clearest economic data does not come from government reports. Sometimes it comes from millions of ordinary people all noticing the exact same thing at the exact same time.